Hello and welcome to Help Me Buy Property Podcast. Today we are going to discuss if this is a good time to invest. It's $1 million questions. We are going to talk about the trends that we are seeing in the industry, what rental crisis really means, and why do people keep referring to it getting worse? How many more interest rate rises are coming through in the pipeline, and what does that really mean for the market? And lastly, what is the buying window of opportunity? What areas to invest in, what areas to not invest in? And with that, let's give a big round of applause to my lovely co-host, Miss Cheryl Leon. Cheryl, happy
And the
Friday.
crowd goes wild.
Woo!
Good morning. Hey, Moss. How are you doing? This is such a cool topic to be talking about, especially right now when, we're seeing a lot of really sort of anxious, negative consumer confidence.
100%.
I mean, obviously there's markets within markets, but the markets, especially like, Queensland, where I'm in at the moment, where it used to be crowds and everything. And I'm seeing like it's crickets in some places.
Yes, definitely.
And the question is, is it a good time to buy? Or so we're going to be highlighting a few of the things to consider. And then I guess at the end of it, we'll make some sort of a assumption and some thoughts around what we think.
Definitely. I think this is more of like the analysis of should we be buying, right? We are looking at various different drivers and, unpacking some of these conversations that are happening in different silos. And so we're bringing it all together. Kicking this off, anyone who asks me that question, I always say to people that I made my best money in times like these. Okay. And so there is no doubt about at least that sort of mental and mindset change that these are the times where your fundamentals should be strong and you should be double dipping. And we'll come back and summarize this at the very end. Let's talk about immigration. I think the media is talking about immigrations. You see buyers agents, property sales agents talking about immigrations. China opening its borders. And let's talk a bit about that. What do you think, is happening at that end?
Well, I'm seeing this firsthand. I know of friends who are overseas, and because the borders have opened and because, there, maybe instability in their own countries and so on and so forth, obviously COVID's caused quite a bit of a stir and put a lot of things on hold. But the fact that there's borrowing, you can borrow from Australian banks. Australia is looked at a safe haven, and people are physically moving either back to Australia or coming to Australia.
Definitely.
So there's a lot of money. I mean, I've got a family friend who's basically, he'll be coming in April, and he says, I've got 10 days to buy a property.
Wow.
In cash, and it's because I need to get money out of my country. So these are conversations that are happening on a daily basis now. And it is a matter of people just getting money into Australia. And there is monetary policy, and we're seeing borrowing policy that is supporting that. I do recall seeing in terms of a lending policy regarding not foreign buyers. So, that market's opening up. And Australia is still looked at as affordable in some areas.
Yeah.
And even where it's unaffordable, that it's premium. You've got the lifestyle, you've got a stable market where it's not fluctuating all over the place.
Definitely.
So that's definitely going to impact.
And further adding to that, when you talk about immigration, I always split immigration into two sides. I see the student immigration, that is going to cause rental crisis. And then you talk about immigration in itself, where people are actually migrating to Australia, right? And so, I was reading some of these stats across the board, and they were saying that, 70% of the cases that were there pending, the Labor government has basically come in and started giving, these people right to enter into Australia. I have a few friends who waited 3 years during the COVID time, to get their residencies and come, into in Australia. And so I believe that there would be a lot of stories where people are coming into some of these things. You look at the Treasury forecast, the Treasury is talking about more than 300,000 people just migrating this year, 25% higher than any other year. And so that's, superlicious numbers. These are massive numbers, right? And so if you think about some of these impacts and you combine this with students coming back, Chinese students, Indian students coming back because, now they can study onshore rather than offshore, I think the market dynamics completely changes because we know that, Malaysian, Singapore, China, India, when these students are coming in, the parents are keen to buy properties for these, people because, it's an investment and, and they can just live there, while keeping their cost of living down.
Yes. Yeah, yeah. And it's a cycle as well because we've got such a tight rental market. And we've seen this. It gets to a point where, when you're paying more in rent than you would in a mortgage, then it gets to a point where people make the decision as to, I might as well buy. I might as well buy. If it's that expensive to rent, I might as well buy. And so it just kicks off another cycle, right? But it does start with that rental pressure. And again, with this migration that's coming in, there are going to be more people that rent as well. In the meantime, while they get accustomed to where they're living, and then they end up buying. So you can see where that whole knock-on effect happens as
Definitely.
well.
It's a very important point that you make that, especially with the migrations. I know from, countries like, India or Singapore or Dubai, right? These people are mature individuals who've been working, half their life in these countries, right? And so when they land Australia, these are not poor people. They come with deposits ready to go, right? And so it's in their natural soul that, property is a safe haven. You should always invest in property. They've been buying properties back home. And so naturally, they're like, okay, as soon as I come here, the first thing I do, 6 months down the track, I buy a property. And so that's the net migration impact that you would see is causing, or would cause the prices to go up. And that's what media is indicating. I think some of the key statistics, if we tend to look at it, and I'm talking more from, the population statements made by the Treasury, there are high and low scenarios that they're quoting, in relation to the migration scenarios. And so they are saying that by 2060, Australian population can get to either 39.2 million or about $49 million. And so, not dollars, people. And so that's a lot of people, right? Between now and 2060. And so, if you track back and think about some of these things, what does that really mean? I always say this, that no one in an Australian market wants the prices to go down. Naturally, everyone wants the prices to go up, right? And so people talk about first-home buyers and they say, oh, we should be helping first-home buyers entering into this space. Technically, they want the prices to be down only when they're buying, right? As soon as they've bought, they are fingers crossed, I want the prices to go up as well. And so if you look at the market dynamics, you're talking about 70% of the market, which is owner-occupiers, investors, 30% of the market, or less than 30%, even 20% of the market, which is first-home buyers. And so, of course, if 70 to 80% of the market wants the prices to go up, the prices would go up. And that's the muscle memory that people talk about, right? Because they are the one dictating and driving the market. The other important point to consider here, and this is going back to my grassroots level, right? And so you look at countries like Dubai, India, Singapore, even UK, people don't buy first homes. There is no sort of granted notion that, you are going to be born and this is your birthright of buying your first home. Okay. A lot of these times, the houses travel in generations and you get a house passed down through generation, right? And so I strongly feel that, the next 20 to 30 years for Australia is basically us going through that cycle. Okay. The houses prices would go down to that level of, the higher echelons where, we're not talking about anymore about first home buyers because the market is so far outreach from these people. And so we are talking about generational wealth and this difference of, people having investment properties versus people, looking for properties would be so massive and so big that, people who have done well in these 20 years would be far ahead of the curve, rather than people who are still.
You raised such an interesting point there, and it's so true. I look at it now from a cultural perspective. Being, coming from an Asian culture, it is not, it's very rare for people to go and buy their first homes. I mean, back back in the days. It is a generational thing. And I'm wondering if we get to that point because we are so ingrained. And the government obviously helps that and so on and so forth because we were talking about stamp duty today. My husband asked about why do we pay stamp duty? I'm like, let's not go down that path, right? That's how the government earns its money. So, it wants transactions to happen. The government wants transactions to happen. And depending on what state, stamp duty makes a lot of money for the government.
But so can I pause you there? Can I just pause you there? Think about stamp duty. Why is the state government, or a lot of state governments transitioning from the dependence of you changing hands and transitioning stamp duty into land tax? And so one of the reasons, I feel is basically that reason, because they know that this transactional change would be lower and lower as people, start buying less and less, and it's going through the generational wealth. And so they want to put that trigger in that, the property is created, we want money for infinity.
Right? Absolutely. And people are starting to, you get grandparents that live with you, your children are living there longer and things like that. We've got people who are living, building granny flats and all. So it is a very interesting transition away from that to a longer term land tax application. So not only from an affordability point of view, going, actually, we can make more money this way in the long term. Because it'd be interesting. We haven't looked at the statistics in terms of whether there are less transactions in that sense. Are people doing less of those? Is there a longer time that they're actually staying in that one property than it was before?
I think I've looked at some of this data more from a Victorian government perspective, while consulting with the Department of Treasury. And I know that an average hold period in Victoria is somewhere around 8 years. And so, that period has actually gone up. It's not coming down. And so if you look at the trend, that period keep going up, so people are not transacting or changing houses as often. And that's where the government is playing its part. And they're like, okay, in the short-term cash flow side of things, we might make less money because, it's transactional based. But, as the pipeline keeps coming through, on a longer term basis, if you look at 6 to 12 to 15 to 20 years, we actually make shit ton more money, right? And so, that's definitely the case.
Yeah, absolutely. Let's talk about one of our favorite topics in terms of developers, builders. Builders. If you've been building over the last 2 or 3 years, if you've been a builder or you've been building stuff, oh my goodness, what a roller coaster of a ride it has been.
Yes.
However, we're seeing some level of stability happening.
Yes.
We don't have these crazy materials increases. Still have some level of labor shortage. And that's something, I think that ties back to migration as well. A lot of labor was from overseas as well.
Yes.
So what are you seeing? What is the impact of builders and the building industry sort of stabilizing? What does that mean?
I think it's very important. I think the point that you make in relation to tying it back to migration is the key, but also that the government infrastructures, where the infrastructure is coming in quite strong and fast, that a lot of people who are coming out of the building industry working into residential space are moving more into commercial space or government projects. And so that shortage of labor still exists. It hasn't disappeared because people are redirecting their energy towards these infrastructure projects. Now, the interesting thing with building industry is that, one of the key things that I look at is the number of policies that are being sold at a state level for newer buildings, so newer dwellings. Okay, and so if you look at the policy numbers have been very stable. They were high, of course, between 2020, 21, 22, and even 23. And so that numbers of policies have gone from like 60,000 to like almost 90,000, and topping over every year. The interesting thing here is that the builders who were supposed to go broke have already gone broke. And so that stabilization and loss-making business that the builders had, that has been transformed or has been translating into new business. Okay, gone are those days where we are talking about, big giants like Metricon falling, right? And so builders who never managed their cash flow properly, knows what a business downfall looks like, and they've seen that happen. Okay, and so fortunately, unfortunately, they are out of business, but the pressure lies behind for those who are now remaining in the industry, and they still have a lot of pipeline to finish, right? So while the new business might be slower, the pipeline is still quite warm and quite hot, and so they are trying to quickly get through that pipeline. And so I think builders going out of hot water is a very interesting dynamics, because it's stabilizing prices while labor shortage is
Yeah.
temporary. My understanding is that that would get better, and so that would be one of the key things that would indicate about whether we should be investing or should not be investing in right now.
Yeah, I'd say with the builders, because we've gone through such a rough patch with them. I mean, so many delays, builders going bust, that sort of thing. I mean, we're not hearing about these. We're sort of at the tail end of those delays, I'd say. If you're wrapping up a project, hallelujah, it's coming to an end. And the fact is that builders are, again, starting to get back to some level of normality, which should hopefully bring some level of confidence into that space again. We got more land, land is starting to get released. And, they're settling land, they're starting to build. So you're going to see more activity start to come up from, the bloodbath that's happened in the last few years.
Definitely.
And that's when you're starting to see, again, those prices, probably prices start to move up.
Yeah.
Development, what are you seeing in the development space, Moss? Are you seeing that developments, and this is not builders, we're talking about actual developments, more development activity happening, less development activity?
I think, every time I speak to a developer who has a site that is ready to go, I feel that nervousness is definitely there, and that's playing its part. With rising interest rate, build price is still, significantly higher than what they were expecting, say 12, 24 months ago. Their appetite to develop has definitely come down, which means that, there's a lot less stock on market. Even people are scared from building as well. And so there is not a lot of land sales happening. And so people are like, if you have a finished product, I'll buy it, but I don't want house and land anymore. I don't trust the builders. I don't trust the process. And so there is a lot of that happening as well. And so that constraint is definitely playing its part. You can see, one of the key indicators that we follow here is, say, building approvals. And you can see a sharp fall in building approvals over the last sort of at least, 2 quarters. And so it's interesting, I say this, that, people who are brave and have seen markets like this before know that this shortage of supply would continue towards the demand pressure, which ultimately goes back into the price increases. And so you will get your prices. And I was having an interesting conversation with my own project manager where, we are looking at a particular project, and the prices are like, $30,000 to $40,000 versus where our GRV was. Still profitable, but it does leave a bad taste in your mouth. And so, are you brave enough to still go ahead and build it, knowing that the muscle memory would come back and the prices would go back to those levels, or would you just sit tight and wait for everyone to happen? Now, what do you think about some of these impacts, Cheryl?
Yeah, I'm seeing developers a little bit jaded.
Yes.
In what's happened in the last sort of two years. I've had sort of commentary around, I'm just going to step away from building for a little while and just develop land, and someone else can do the build. So you're not exposed to all those uncertainties. That's happened. We've had uncertainties with obviously pandemic, weather, we have bushfires, we have all sorts of things. Australia is the best place to live, but you've got all of these to deal with. Like the most sort of small, medium-sized developers are probably not being they're a bit more risk averse, I'd say, in that regard. Probably pulling back a little bit more and looking at more maybe smaller scale developments where there's a quicker turnover. They're not relying so much on pre-sales and things like that for large townhouse developments.
Definitely.
Because and I'd say that's probably a prudent thing in the current market, because the success of your project obviously depends on, people purchasing, people having the appetite to purchase, and where there's low consumer confidence, then that's going to have a knock-on effect.
Yes.
I'd say that there are definitely, I'm seeing a lot more people, if they're developing, they're doing a build to rent.
Yeah.
A build to rent model where there's larger focus on cash flow.
Yes.
and less on and holding long term in the market, time in the market, as opposed to relying on the revenue from sales.
Yeah. And I mean,
are you seeing that as well?
Let me play the devil's advocate here, right? Because I was talking to a person yesterday, and I say to them that while you're holding this particular property, right, at 1.5, $1.6 million that you've acquired, you're getting a rent of say 400, 450, 500 on it. While the interest rates are rising, you are eating away into profits technically, right? Because your GRE is not really going up. And so would it not be in your best interest to start doing the developments so that you're ready, right? Because ultimately you need to take that exit, right? And so where does this stop? One of the key things that I'm noting at a grassroots level, and this talks to more about the change in markets, is the quality stock is still selling really, really well. I was on 7 News in an auction last weekend, and I kid you not, there were more than 55 to 60 bidders in that particular auction. Okay, so there was a lot of, and so if the property is presented right, the property has all the bells and whistles, it's in the right market, it is an investment grade property, people are still coming out to buy these properties because they know that these prices would not return. Are you feeling some of those things as well with the change in markets, especially in bigger markets?
Yeah, there is low stock. There is lower stock. So the quality stuff, there are always going to be people looking. I want to share them, and I'm always of the mindset that you have an abundance mindset. And you only, when you're selling a property, you only need one person who really loves it to fund it. If you've got unfortunately, if you don't have an investment grade property, and we talked about this in a previous episode, like it's not presented very well, it's not in a great location, it's going to suffer in some way. But if it's, if you're targeting the right market and it's value, then it's going to sell. People are always going to be looking. We've had such huge equity growth over the last few years. There are people that are upsizing. There are people that are downsizing. There's money there. There's definitely money there, and people are looking for the right opportunities. So I'd say, yeah, I totally agree with that. And don't feel that you need to make huge amounts of discounting.
Yes, definitely.
And I do think the marketing campaign helps incredibly with that.
And don't give into the fear, right? A lot of people sell in fear, right? I say present your property well, and put it out there, attract the right sort of buyer, right? And you would get the price. It's all about presenting the property well. And so there were properties selling at 8% interest rate, 9% interest rate, 12% interest rate. So this is not a doomsday scenario. When people come and say, "Oh, this is what doomsday look like," it's like, no, we are way far ahead, way from what a doomsday look like. This is what a normality looks like from my perspective, right? And so if I take this to
we had interest rates at 8-7% not long ago.
100%. And so I think that's a good segue in talking about, media is talking about fixed mortgage rates coming to an end, and people waiting for this bloodbath to happen. And people are like, oh, I'm going to buy properties that are worth $1 million for $400,000 because that's the psychological thing. What do you think about some of these comments that you see that, there would be a bloodbath with fixed mortgages ending, in May or June?
Speaking to a few mortgage brokers, there is going to be strain for quite a few people who didn't quite plan very well. And I'd say, when in saying that, like the lending policies, when people were borrowing at 2-3%, like the lending policy would factor into rate increases of 5, 6, 7%. So they were there, like they were already, like the banks were already starting to tighten lending policy because they knew that this was going to happen.
Definitely.
So I'd say, we've got to take some level of responsibility in that aspect. That that we all knew that these incredibly low rates, which we'd never seen. I don't even remember when we had rates that low, was short lived.
Yeah.
Right. And to factor into a buffer, whether it's enough equity capital in the property, or the fact that you just had enough of that buffer to, if we stretch ourselves too much and overextend, then we're going to find ourselves in a bit of strain.
Yeah.
But strain doesn't necessarily mean it's a bloodbath.
Yes.
either.
And
we expected a bloodbath in the pandemic
yes,
as well.
yes, and
There really
that's so
wasn't
true.
a huge
That is so true. I think if you think about this, a lot of the people coming out of even fixed mortgages, right? They would have buffers built into their risk margins, right?
Mm,
And so I always think about it in a sense that, okay, any distress sales or truest nature of the distress sales that you're talking about would potentially take 8 to 12 months because people have that buffers to basically live this through for the next. So
mm,
anything that is actually
mm.
going to happen would probably happen next year, not this year. Okay, so that's number one.
Yeah.
The second sort of thinking that I have, and this is more on a much more simpleton thinking that I say to people, is, if I have four properties, right? And if I am struggling, the first property that I'm going to bring out to the market to sell would be the most crappiest property, right? Because I'd be like, this hasn't done anything for me. I want to sell this out. And so the one that I don't like, no one likes it, my friend. Like, so it's not going to sell, right? And so you see a lot of crap sitting on the market because it's everyone's crap coming out there trying to flock because they don't like it, right? And so it makes it a lot harder where that, while people are saying stock levels are coming back, that's not the same stock. The mix has changed. This is a brand new mix, and it's a lot of crap that you shouldn't have bought in the first place,
Mm,
calling in investment properties, especially in that dynamics. And so, yeah,
mm,
it's a very sort of interesting dilemma that, a lot less quality stock, better quality stock every time it comes in. We are seeing, for example, even right now, yesterday in Adelaide, we were looking at that particular property. There were 8 offers on that one property. And I was like, hey, are we
yeah.
back to like pandemic levels? Like, what's happening here? I thought that the interest
Yeah.
rates are rising and
Yeah.
people are, playing poor, but that's not the case. In Perth, in Adelaide, parts of Brisbane as well. It's still there, in those quality stock
Yeah.
markets.
And there's still a lot of internal migration happening, right? Interstate migration that's happening.
Yes.
And I know especially in places like more so in Perth because from all the eastern seaboard where they're going, oh, so cheap, let's move there.
Yeah, definitely.
And the weather's so much better and it doesn't rain all the time. So there's a whole lot of interstate migration that's still happening. There is a mass exodus.
Definitely.
Oh, sorry, Melbourne and Sydney, that people want to go to places that have better weather, less traffic, and and obviously, more affordable in that regard. So
Yeah,
that's pushing those particular markets. We've got markets within markets, like we said.
definitely.
Not all the markets are going to be performing at the same time,
Yeah.
but it will be. It's around understanding where the activity is happening around
Yeah.
Australia.
And if I take this to the next step, for people who are actually waiting for the bloodbath to happen, naturally, I think that these people are there because they are afraid to make mistakes right now. And so they're like, let's wait for the market to bottom out and then we will come in.
Mm,
And if you think, I quote this quote from Einstein that, the only person who never makes a mistake is the person who has never done anything. And can I add to
yeah.
this that, if you, the cost of doing nothing means that you are nothing, right? Especially in the real estate
Mm,
sense. And
mm.
so if people are playing the weight game and chasing the bottom, what do you say to them, Cheryl? What do you think, is that response to those people who are trying to chase the bottom?
What, trying to chase the bottom?
Yeah, look, I mean,
I mean,
yeah,
you can't time the bottom. I mean, you are lucky if you do, and there are going to be certain triggers that you understand. I think through experience, identifying what when say you're stock trading, the market goes this and this, and you're like, oh, at this point where it crosses, that's when I should buy.
yeah,
The old adage of time in the market. If this is an opportune time to purchase, and you're not transacting within the next 12 to 18 or even 3 to 5 years,
mm,
you've got good investment grade stock, then why not? If it drops a little bit, but then over the next 10 years, it doubles or more,
definitely.
then
Yeah.
you've done well.
I think it's the cost of waiting, right? I think one of my mentors, I still remember him saying to me that, he was walking down, and this might sound mean to a few people, that he was walking down in one of the countries and there was a board, which was a funny board that was there, and it was more in relation to people who are waiting. And it said, or it read that, you can get a free abortion here, but there's a 12 months wait. Right? So if you,
Oh, wow.
um,
There's a whole lot of like moral stuff in that one. That's interesting.
and so if you
Yeah,
think
we
of,
won't go into that. I think that's another podcast in its own.
yes, and so I think if you take a step back and you think about the opportunity cost of waiting, some of the impacts that I am seeing with a lot of people that I talk to on a day-to-day basis is that their serviceability with each interest rate rise continues to go down. And so their ability to buy a quality stock continues to go down. I'll give you a recent example of a person. He came to me late last year, and he said to me, Moss, I have a serviceability of $1 million. I can potentially buy 2 properties. I spoke to him 2 weeks ago, and the broker could not even get him $450,000, and he was struggling. Like, he's like, "Whoa, where did it go?" And it's like, "Well, you have a lot of equity, my friend, but because you haven't been playing the offset strategy, that boat has now sailed, and so you have to wait for the risk, the margins to come down, or your salary to go up to basically come back into the market." And so he has missed that opportunity of entering into the market completely while trying to chase the bottom, right? And the waiting game is purely for those people who have redraw available to them, who have played this game before. They have money sitting in the offset account ready to go. And they are the people who are not dependent on the banks to give or borrow the money. They have that borrowing readily available to them. Waiting game is perfect for them. The most important thing in some of these instances where you're playing against your borrowing capacity, you're playing against your serviceability, is that when the market comes back, and we've seen this time and time again, the market comes back a lot faster than the rates coming
Yes.
off. And so by the time
Yes.
you reach your borrowing capacity to actually get into the market is gone. And so, it's like, by the time you're all dressed up, ready to go to the party, done your eyelashes, your tux, your glasses, add a bit of perfume, you realize that the party's ended. That's it. It's gone.
That's you dressing up for Mardi Gras there, your eyelashes and your tux all
Well,
together
I'm
in
trying
one.
to be inclusive, right? So,
No, it's wonderful. I love it.
and so,
Yeah, I get the analogy there. Like it is like there's a slower drop than there is a a faster recovery.
yes. And that's why you see, when you talk about markets, but in markets, that makes a lot more sense, right? Because there are even pockets in Perth right now that have gone up by, more than 15% in the last sort of 6 to 8 months, even 12 months, when you talk about it. You look at Kivana region, you look at Rockhampton, you look at the north, around Clarkson, where, we were buying around 420, 450, up to 500. They're all at, 550, 580 sort of price point. Even Secret Harbor, we were buying that at 420, 430. Now they're well above 550, 560. And so I'm using some of these examples predominantly from Perth, because everyone has been starting to talk about Perth. And, we were buying in Perth in, December 21. And we were the first ones to basically start calling out Perth. And so these are the normal cyclical nature of events that happens. And so people, who have seen these cycles, would pick this up quite quickly.
Yeah.
Let's talk about the most important thing. And I think this is like epically everyone talks about every month, and that is the inflation. Inflation. It's
Yes.
going up, it's going up, it's going up, it's costing us money. What is your take on inflation?
And inflation, what we've seen, I think last year in its own, there's been sort of an 8% inflation. It is expected to, I think, pull back a bit, but wages haven't caught up as quickly.
Yes.
And so we are seeing things that are more expensive. However, we're not seeing people spend on, apart from traveling, everyone's traveling.
Yes.
But we're not like the cars. If you look at cars, right? At one point we had this problem with waiting for cars and pools and everything else. Everyone's done that.
Yes.
They've all done that. And they go, what am I going to spend? I'm going to spend on travel, and
Definitely.
a lot of people start to spend on property. So inflation, I've found in general that people get to a point where there's a level of discomfort at the beginning, and then it gets to this point of a new normality about what the rates are. And I find that there's this sort of lag in terms of what the true impact of inflation is. I mean, we sort of see broccoli at some ridiculous price, $10 a head
Yes.
or something like that. And at first it is a big shock. I find we spend less on the unnecessary
Yeah,
things as well.
definitely.
So I feel that it sort of impacts on our buying routine
Yes.
and the way that and what we're buying and how we're buying and spending
Yes.
on
Yes.
things.
Yes. The spending
However, the
pattern
consumer,
changes basically.
yeah, the spending pattern, that's the word. That's the thing that I'm looking at. And I'm seeing particularly inflation in Australia. I'm not talking about sort of other countries and things like that,
Mm.
where it is making things more expensive,
Yes.
but we tend to almost settle down to a point where you go, this is the new it.
This is the new norm.
I've just got to,
Yes.
yeah.
Yes.
Yeah. What do you think?
While the inflation is slightly coming off, we saw the new numbers coming in at 7% versus 8%, unemployment going up. One thing to
Yeah.
note in relation to inflation is that Australian currency is still cheaper for people who are dealing in US dollars, right? And so when you look at the full story and the full picture, right, you talk about net migrations who have dealt in Australian dollar in US dollars. You're talking about people coming from Singapore, Hong Kong, India. Their currencies are a lot stronger, compared to where they were
Yes.
before, right? And so their ultimate purchasing power is a lot stronger than a local Australian, right? And so you're right in saying that while the discretionary spending is in a crunch mode and people change their spending pattern, a lot of the inflationary impacts actually show up 8 to 12 months down the track, because you can only kill yourself so much. You stop having that extra coffee.
That is true.
Yeah, you can
Yes.
stop eating out, but it's not in infinity, right? And so there is a trigger.
Yes.
And usually that trigger happens past 9 months time, past 12 months time, where people are like, yeah, this is not happening, this is ridiculous, right? And so that's where the real stress comes into play. I think people trying to look for stress right now in the property market due to inflation, and they're not going to see that impact, the true impact of inflation or the rate rises right now. And
how do you, are you seeing that impacting, how are we seeing that impacting on property prices in that regard?
Look, ultimately, when you think about inflation, right, there is a few things that comes together at the same time as inflation, okay? So you have to look at the equity markets at the same time. You have to look at the affordable housing at the same time when you're talking about inflation. You can't just talk about inflation and not talk about these things, right? And so when you see people who are paying more money in rental because the inflation is going up, because the landlord or the owner of the investment property is charging you more rent, that's playing its inflation. That's the impacts of them increasing the interest rates, or feeling the burn and passing that burn down to the renters, right? On the other end, if you think about the financial markets and the equity markets, where the market is going, the volatility, the first thing that people think about killing that volatility is buying into things that can absorb inflation. Okay. And so those things are long-term treasury bonds, gold, like actual gold, or property, right? And so while people are not confident on long-term bonds because the return on these are quite significantly lower, no one is going to go out and mine gold or put all their portfolio in gold. It used to happen before. The property becomes a natural choice. And so every time you would see financial markets taking a dip, or equities market taking a dip, people will jump into property. You would see superannuation. It's trending right now. Why is that? That is because of that reason. People are like, well, I've just lost $4,000 in super, or $5,000, or $10,000 in super. So naturally people think, how do I save my investment? I put it in property. Okay. And so if you look at the holistic picture and you combine all of these together, you realize that the rental pressures would still keep pushing people towards buying. The financial pressures of not getting the returns on the investor side would still keep pushing people in buying that property, right? And so that cycle never ends. Naturally, everything points down to inflation proof or inflation absorbing investments. And that's what it comes down to.
And are you then seeing then this roll into, because you've got people who are moving away from these investments where they might have not seen returns and they're going to be looking at property. Like, where are we seeing the banks in all of this in their lending policy? Are they providing? We've got both ends of the tightening lending policy. You're not being able to borrow as much.
Yes.
And what's the flip side? Are we seeing some light at the end of the tunnel there with the banks?
Look, it's interesting, right? So banks are mandated by APRA directing what the banks need to allow for in relation to risk margin. And I know in November, APRA raised that percentage by, or it's called the capital risk charge, by a minimum to 1%. Okay, and so they have to allow for, when they're making an assessment, they have to allow for an extra 1% in your assessment, etc. Right? And so they indicate every month, whether they're changing that percentage, and that gives the banks the ability to basically lend or more money, right? Now, think from a bank's perspective. If you put yourself into the bank's shoes, banks have tremendous amount of money, because people have caught so much growth and taken that money out and put it back into the bank, be it in their offset account, etc. So they have tremendous amount of cash flow sitting with them, with the government printing the money, and that money now stuck into the bank. And so banks are actually dying to give money. And so what I'm feeling and what I'm finding is that there is all these creative ways that the banks are lending this money out to people who shouldn't be getting the loans as well. Like, I'll talk to this particular example where this person went to major banks, and could only get a borrowing of 300, went to mid-tier, and all of a sudden, he could access 650, $700,000 in today's time. I'm not talking about 6 months, 12 months before. And so the banks are keen to hand more money to people so that they can keep their returns and keep their profitability going as well. And so it's
absolutely.
It's a very cyclical nature of things where, the bank still wants the market to continue in the direction that it continues to go. The government wants the market to continue in the direction that it wants to go. It's the people's confidence that's basically a bit of an anchor point in the market, and it's the floodgates.
Absolutely.
As soon as you open that floodgates, you would see the rush coming through.
Yeah, so let's sort of wrap back up to the very beginning. We talked about consumer confidence, and the whole question and the whole topic about today is around, is it a good time to buy? Is this the right time? Do we have the right indicators and the foundations for purchasing, or do we just sort of all wave the white flag and just say that's it? I'm gonna sit tight and see where, if things sort of implode. What are you saying to your clients that are sharing their uncertainty?
See, I divide them into two buckets, right? I say owner occupiers and investors. Okay. And so I personally say that this is a perfect time to make a lifestyle choice. This is a perfect time. And I'm choosing my words very, very carefully, right? This is a perfect time to make a lifestyle choice because a property that you are going to emotionally buy for, say, $1.5 million is right now selling at $1 million. And so if you can afford it, it's a perfect time to make a lifestyle choice, right? Buying in the markets like this, because even if you're playing to your emotions, you're paying a ridiculously low price in areas like Melbourne and Sydney, okay? Because the vendor's expectation has changed. In an investment dynamics, when I'm talking to an investor, be it SMSF, be it in their own personal portfolio, I say to people that you need to understand your risk. You need to mitigate and understand your risk and ensure that your portfolio can absorb these shocks that are there, right? We've talked about interest rate rises and how many interest rate rises are coming through. My expectation and understanding is that there is at least 2 or 3 more interest rate rises based on the inflationary numbers and everything else that we're talking about. Yes, the intensity might be lower, but those rates are there. Okay. And so while your serviceability disappeared, gives you an opportunity to buy right now. Buy something that is going to sustain your portfolio rather than just going out in the dark, picking anything. Because gone are those days where you go out in the dark and pick anything, because there is a lot of garbage on the market. And so you need to be a lot more careful in picking the right stock, especially in times like today, because there is a lot of crap on the market right now. On the SMSF side of things, it's all about growth. And so it's all about yield, it's all about growth, and so you can't discount the growth in that sort of notion, because SMSF lending right now is sitting at almost like 7%. And so you need to ensure that while your contributions are not getting leaked, towards the holding cost, your rent from the properties is at least covering the repayments and the holding cost side of things, and your principal is basically your repayments or the contributions are basically getting paid towards the overall the principal side of the loan. And so those are the three sort of buckets that I'm placing people in and having different conversations. What do you think, Cheryl? Do you think that it's a good time to buy?
I personally think it's a great time to buy. If you can, in the less technical sense, and just seeing what's happening in the market, that if you've had property previously, and I guess it's different to if you're an existing homeowner, and I said property owner, you've got a lot of equity that's sitting in your property. Leverage whatever serviceability that you have and buy in good investment grade areas. If you don't know what they are, then seek out some advice around that or some direction around that, because it is around the whole adage of it's time in the market, not timing in the market. And be what our good friend Warren Buffett always says, be fearful when everyone's hungry. Is that right?
Yes.
And be hungry when everyone's fearful.
Perfect.
And why do we do that? Because if you're waiting for the market to recover, by that point, like there's a lag in that recovery. There's something that's happening in recovery, and the media is not always going to pick it up right at the beginning and go, "It's a recovery." There's no big signage about the recovery. So by the time you've already realized the recovery's happened, it's already sort of at its mid to high point, and you're in there competing with a whole lot of different people. So
100%.
I'd agree. I mean, be mindful of what you are purchasing. Not just purchasing any old property. The location obviously needs to be right. Leverage the equity and the serviceability that you have now. And I'd say look for opportunities to earn more. And if it's through your properties where you're renting it out, you're getting a good yield, that's one way to earn more.
Definitely.
Whether you can earn more in your own career, or you can earn more in business, the more that you can leverage that serviceability is going to be better for you.
Amazing.
So I think, I'm seeing great stock at the moment in places where, like, when I say stock, it will be opportunities, good opportunities which weren't there before.
Definitely.
The markets pulled back a little bit. Like, take that opportunity to ride the wave.
Definitely.
Hashtag Sunshine Coast.
Yes. And I think Brisbane, Queensland, Melbourne, Sydney, all of them offers great opportunities right now. I'm not saying that everywhere in Perth doesn't. I think at the cheaper price point, it definitely does. But vendor expectation have adjusted massively in Brisbane, Melbourne, and Sydney. And so you're exactly right that there is massive opportunities even for development stock right now. And so people who are keen to transition into that space, I think this is the time. Yes, there would be a bit of pain, 8 months to 12 months, but you would see that pain disappearing quite quickly.
Write it out. Write it out. If you have the ability to write it out and have a strategy, I think it's really important that you have a strategy and a plan to do so, that you know what you're doing. Just throwing money at things. Then this, prepare yourself, get your team in order. We talked about team in another episode. Your mortgage broker, your accountant, your advisors, to make sure that you're working on a strategy that's going to actually build you wealth
100%.
in the long term.
100%.
Yeah.
I think this is a wonderful advice, Cheryl. Let's close it at that. One last line. Media is here to entertain, not educate. We are here to educate you. Take the advice, listen to the whole podcast. Thank you very much, Cheryl, for contributing so much well today.
No, thank you. Thank you, Moss. That was really, really good. And said, I'd love to hear what people are thinking, and whether it's, having shared what we've shared, what does that resonate with you? Are there things that have made your thinking sort of shift as well? And the intention is not to necessarily change your mind, but it's to sort of influence your thinking as to think more broadly, apart from what's in the media. Turn off the TV. There's always going to be a whole lot of noise, but look at the facts and the figures and the data. Right? That's what Moss does.
100%.
Awesome.
Thank you very much. Stay safe, keep smiling, keep investing. This is Moss and Cheryl checking out. Adios.
Take care. Bye-bye.